This CTA screencasting project is supported by the South African Institute of Chartered Accountants and the Auditor General of South Africa via the Tutuka program. As part of discussing IFRS 15, I will focus on the 5-step revenue model. Each step will represent a separate screencast. In this 4th screencast, I will now discuss the 4th step of the revenue model: allocate the transaction price to the performance obligations. The objective when allocating the transaction price is for an entity to allocate the transaction price to each performance obligation or distinct good or service in an amount that depicts the amount of consideration to which the entity expects to be entitled in exchange for transferring the promised goods or service to the customer. To meet the allocation objective, an entity shall allocate the transaction price, as was determined in step 3 of the revenue model, to each performance obligation as identified in step 2 of the revenue model on a relative standalone selling price basis. What about discounts and variable consideration? I will address these in a moment. To allocate the transaction price to each performance obligation on a relative standalone selling price basis, an entity shall determine the standalone selling price at contract inception of the distinct good or service underlying each performance obligation in the contract and allocate the transaction price in proportion to those standalone selling prices. The standalone selling price is a price at which an entity would sell a promised good or service separately to a customer. The best evidence of a standalone selling price is the observable price of a good or service when the entity sells that good or service separately in similar circumstances and to similar customers. If it is not directly observable, an entity shall estimate the standalone selling price. Let's do an example. Jungle Mania Limited enters into a contract with a customer to supply a swing, a slide, and climbing bars compatible with most jungle gyms in South Africa. The company concludes that the items are distinct and therefore 3 separate performance obligations exist. It is likely that each item will be delivered at different times. The transaction price is 1,000 Rand. Jungle Mania regularly sells each item separately and has established standalone prices as follows: the swing at 500 Rand, the slide at 250 Rand, and climbing bar at 750 Rand. What is required? Determine the allocation of the transaction price to the performance obligations. Allocation of the transaction price is done based on the standalone selling prices of each performance obligation, thus 500 Rand for a slide, 250 Rand for a swing, and 750 Rand for a climbing bar. The total of the standalone selling prices being equal to 1,500 Rand, the standalone selling prices are observable and thus are used. The transaction price of 1,000 Rand is allocated to the slide, swing, and climbing bar, each a separate performance obligation, proportionately based on the standalone selling price. Thus, 333 Rand to the slide, 167 Rand to the swing, and 500 Rand to the climbing bar. Revenue will be recognized at a point in time when control transfers to the customer. This will be discussed as part of Screencast 5. An entity shall allocate a discount proportionately to all performance obligations in the contract, except if the following criteria are met. The entity regularly sells each distinct good or service or each bundle of distinct good or services in the contract on a standalone basis. The entity also regularly sells on a standalone basis a bundle or bundles of some of those distinct goods or services at a discount to the standalone selling prices of the goods or services in each bundle. And lastly, the discount attributable to each bundle of goods or services is substantially the same as the discount in the contract, and an analysis of the goods or services in each bundle provides observable evidence of the performance obligation or performance obligations to which the entire discount in the contract belongs. If the above criteria are met, an entity shall allocate a discount entirely to one or more, but not all of the performance obligations in the contract. Variable consideration that is promised in a contract may be attributable to the entire contract or to a specific part of the contract. An entity shall allocate a variable amount and subsequent changes to that amount entirely to a performance obligation or to a distinct good or service that forms part of a single performance obligation if both of the following criteria are met. The terms of a variable payment relate specifically to the entity's efforts to satisfy the performance obligation or transfer the distinct good or service, and secondly, allocating the variable amount of consideration entirely to the performance obligation or the distinct good or service is consistent with the allocation objective when considering all of the performance obligations and payment terms in the contract. The normal allocation requirement shall be applied to allocate the remaining amount of the transaction price that does not meet the above criteria. The incremental costs of obtaining a contract are those costs that an entity incurs to obtain a contract with a customer that it would not have incurred if the contract had not been obtained. For example, sales commission. If the entity expects to recover these costs, an entity shall recognize the incremental cost of obtaining a contract with a customer as an asset. The contract asset is amortized on a systematic basis that is consistent with the transfer to the customer of the goods or services to which the asset relates. An entity may recognize the incremental costs of obtaining a contract as an expense when incurred if the amortization period of the asset that the entity otherwise would have recognized is 1 year or less. Costs to obtain a contract that would have been incurred regardless of whether the contract was obtained shall be recognized as an expense when incurred, unless those costs are explicitly chargeable to the customer, regardless of whether the contract is obtained. If the costs incurred in fulfilling a contract with a customer are not within the scope of another standard, for example IS 2, inventories, IS 16, property, plant and equipment, or IS 38, intangible assets, an entity shall recognize an asset from the cost incurred to fulfill a contract only if those costs meet all of the following criteria. The costs relate directly to a contract or to an anticipated contract that the entity can specifically identify. The costs generate or enhances resources of the entity that will be used in satisfying or in continuing to satisfy performance obligations in the future, and the costs are expected to be recovered. The contract asset is amortized on a systematic basis that is consistent with the transfer to the customer of the goods or services to which the asset relates. If a customer has the option to purchase a warranty separately, for example because a warranty is priced or negotiated separately, the warranty is a distinct service. An entity shall then account for the promised warranty as a performance obligation and allocate a portion of the transaction price to that performance obligation. If a customer does not have the option to purchase a warranty separately, an entity shall account for the warranty in accordance with IS 37, provisions, contingent liabilities, and contingent assets, unless a promised warranty or a part of the promised warranty provides the customer with a service in addition to the assurance that the product complies with the agreed upon specification. IFRS 15 Appendix B, paragraph 31, provides guidance to assessing whether an additional service is provided. The illustrative examples number 33 to 35, 36 to 37, and 44 in Part B of IFRS 15 provides additional examples on steps 4 of the revenue model. Thank you for your time and good luck in your preparation for the test.